Hey, this is Rob Beardsley with Lone Star Capital. Today I want to talk about loan assumptions versus all cash deals, or all cash meaning you're coming in with new debt. So I've been getting some questions recently about loan assumptions. Are they something that you should be interested in doing? Should you shy away from them? How do you price them? Or what makes the decision whether you should come in all cash or with, subject to the existing loan? And so it all comes down to underwriting, and the nuances, also understanding the risk-adjusted nature of the deal and the business plan that you're getting yourself into based on the financing. So what you're seeing today, and we'll continue to see for a while, just given the debt markets and where interest rates are, is you're seeing people had locked an interest rate that at the time was attractive. Let's say back in 2016, 4%. Even up to 2018, rates were somewhere, in the low 4% range. And they locked it in for 10 years because they thought, hey, interest rates are low, historically low. They may go a little lower, but you know what? This is an awesome place to lock, and I'm happy to have this rate for 10 years. And so they did. And now they're in year 2, 3, 4, maybe even 5 of that 10-year term where they've got a locked rate at 4.25%, let's say, and they want to sell. And they have to reckon with the yield maintenance or defeasance penalty, which is very brutal and can be, anywhere, could be up to 10% of your outstanding loan balance to prepay, and which makes it, in many cases, uneconomic, and you have to essentially force an assumption to the buyer of the existing note. And so what that's going to do is the buyer is now going to have to underwrite your in-place loan to determine what their best and final offer is for your property. And they're going to have to factor in your above market interest rate. Also, you've probably ran out of your interest only period, so you're going to have to, the buyer's going to have to assume debt that's already amortizing with no IO, probably amortizing faster than 30 years, so their cash flow is going to be hurt. So they're going to want to make up those worst cash flows with a little bit of an IRR premium or a cap rate premium, depending on how you look at it. So those are, just a couple reasons why a loan assumption can be unattractive to the buyer, and the buyer is going to be seeking a slight discount compared to if they could come in all cash. But it's not black and white. There are some scenarios where actually a loan assumption can be beneficial. For example, and this is a business plan that we really love and we're always looking for, and this is where we find a deal that was at acquisition financed with permanent debt, let's say Fannie Mae, Freddie Mac, and somewhere along the way the operations went a little sideways and now the property's underperforming. There might be, let's just say above market vacancy. So let's say the vacancy has dropped down to 20% or gone up to 20%. Now, at that high of vacancy, the only way that you could put new debt on the deal would be a bridge loan execution. And bridge loans, as we know, are higher risk. There's more closing costs and shorter maturity, higher rate, all that stuff. So that changes the risk profile of the deal. But now if I can now buy this value add opportunity where there's underperformance, but I can actually assume the existing loan, which is permanent financing at a cheap rate, and I don't have maturity risk because I'm not locked into a bridge loan that has an 18-month or 36-month term where I need to really execute my business plan. That's a really exciting proposition. I have married an opportunistic business plan with permanent low risk debt, and so that's a really great way that you can find, if you can find it, you can find really strong risk adjusted returns. The last point I want to cover is really analyzing a deal where the broker or the seller is proposing two options: all cash or assumption. They're really being transparent. They're saying, hey, my prepayment penalty on my existing note is $500,000. So this is my price. I want $10 million. If you want to prepay my loan, you need to pay me $10.5 million because then I'm going to go pay off my lender. If you want to just pay me 10, you need to assume the note. So you have just, simple math equation here, and you plug in two different scenarios in your model and you say, okay, let's look at the scenario with an assumption, let's look at the scenario with new debt, and you have to analyze, the risks associated. Again, it's not necessarily apples to apples if you're assuming permanent debt, and then the other option would be new debt that's a bridge loan, right? You kind of have to demand a return premium if you're going to go in with a bridge loan. So yeah, that's the way to approach it. Really just put two side-by-side models and analyze what the IRR, cash-on-cash returns, and the flexibility that you have in those capital structures. Thanks.